Are there signs to you of an early AI bubble forming?
I think the very simple answer is yes, there are. OpenAI's valuation going up from $300 billion to $500 billion. OpenAI doesn't make any money, it loses money. There are ways to play an industrial revolution which don't require you to have to embrace ludicrously high valuations. AI is going to impact every single corner of the economy, financial services, the legal profession, insurance industry, public services as well. The biggest impacts are clearly to come.
Unstoppable Trends is up 38.5% and your top 40 is up 45%.
Here's a classic example of what I've tried to do to position the two strategies in a way to benefit from this industrial revolution. Basically, OpenAI has agreed a contractual relationship to supply their memory devices to Nvidia, who will make the chips that will go into the OpenAI data centers. When the bubble burst, some never came back. The funds that I was running at the time actually went up in valuation.
Is the UK heading for an IMF bailout?
No. It's total nonsense. It really is drivel. I just can't. I'm struggling to understand why everybody's jumping on this, frankly, ludicrous bandwagon.
Neil, I wanted to start this week with a question from one of our members. He says that friends keep sending him articles where it's showing companies positioned to benefit from the current AI boom are predicted to see huge valuations. But to his mind, the market is starting to feel a bit frothy, a bit like the early stages of a bubble. So his questions are, one, is there any evidence to suggest we're in the beginnings of an AI bubble? And two, if the answer is yes, which of your strategies are best positioned to weather an AI bubble bursting? Well, why don't we start with the first part of his question? Are there signs to you of an early AI bubble forming?
I think the very simple answer is yes, there are many signs of a bubble forming. I think the valuation of a number of sort of landmark AI technology businesses would indicate that, not least, of course, what's happened overnight with OpenAI's valuation going up from $300 billion to $500 billion. I just don't know whether that's the right number. I have no way of knowing. OpenAI doesn't make any money, it loses money, and it has to have regular cash injections to cover the cost of what it's doing. Now, you'd expect that to some extent because, of course, it's investing up front. It's doing all the things that I've just been talking about on previous episodes, where the global leading AI technology companies are having to build AI infrastructure in this global industrial revolution. They can't afford to come second. They can't afford to lose that race. So they're all investing upfront to attain some form of dominance. Now, of course, I expect eventually that there will be a number of different winners, if you like, but nobody at the moment is going to accept that they're going to come second or third. So they have to keep investing. Whilst they keep investing, of course, everybody's getting very excited, but the valuations have got very high. And until these businesses like OpenAI start making money and start earning the sort of returns that you can properly evaluate on their investment, it's really difficult to know whether they are appropriate or not.
And they're not only very high, but they've expanded very quickly as well. The valuations have gone from being almost nothing to $500 billion in the case of OpenAI.
Yes. Now ChatGPT is a very high performing model. It compares very well with the other models that are leading this global race. But I'm not smart enough to know whether OpenAI will make a return on the investment that justifies that $500 billion valuation, which I expect will go even higher.
There's also a pretty intense media spotlight on a lot of these companies and a lot of capital chasing a relatively small number of, I guess, foundation models, as they're called, or the leading providers like OpenAI. Does that remind you of earlier bubbles like the dot-com bubble that we spoke about last week?
It does. It has. All bubbles have hallmarks that are shared. Whether it's the 19th century bubbles that we know about that have been documented very well, the Wall Street bubble, what we experienced in 2000 and what we're experiencing now. There's something sort of they're all different. They share characteristics, but they are all different. And this one is different partly because it is so global. It is universal for planet Earth. So it has characteristics that are unique. I'm just not smart enough to know whether these very high valuations are appropriate or not. But what's important is that, just as in other episodes in economic history, there are ways to play industrial revolutions. There are ways to play an industrial revolution which don't require you to sort of leap off a very high diving board and hope for the best. I keep coming back to this same old mantra. If you do your work, do the analysis, work out which companies are likely to benefit, as, for example, picks and shovel suppliers to the AI industrial revolution. If those valuations are appropriate and you can see that those companies are in a very good place to benefit from the huge investment that's going on, then there are ways to play this industrial revolution, which I think will continue for years to come. There are ways to play it which don't require you to have to embrace ludicrously high valuations.
Well, let's come back to that, because I think that will be really interesting for the second part of this question. But I wanted to just ask another question about the potential difference between, because let's be clear, we're not saying, or certainly I'm not saying, that this is definitely a bubble. And I think there are differences with previous bubbles. I think we are already seeing that AI is genuinely transformative. And I think there will be, or there could well be, long-term winners from this. But what's key, and I think what you're saying, is separating the massive amounts of hype from these companies to what is going to translate into long-term value. Is that correct?
Yes, that is correct. Yeah, I couldn't have put it better myself. Yeah.
So look, for anyone who might be concerned about a bubble, the obvious follow-up question, and you alluded to it earlier, is how is that going to affect the W 4.0 strategies? Let's perhaps start with unstoppable trends and your top 40. Those are the ones that have, I guess, been the most exposed to this sector and to the technology sectors, but they're also the ones that over the last 6 months have been the strongest performers. So for context, over the last 6 months, unstoppable trends is up 38.5% and your top 40 is up 45%. Can you tell us a bit about what's driven the performance in those two strategies? Which sectors?
Yeah, yes, I can. So it's been across the board, actually. We've had good performance more recently from renewable energy stocks, which might be counterintuitive because, of course, they were smashed after Trump won the presidential election, and they've recovered very strongly in recent months. So that's one sector that's can perform very well. And the semiconductor sector, which is one that I deliberately focused on because I saw it as a predominant and preeminent picks and shovels supplier to the AI industrial revolution. It's not just that. It's the semiconductor industry is notoriously cyclical. And having gone through a difficult period in 23 and 24, my analysis led me to believe that there was a recovery coming in the semiconductor cycle. Now, overlaid on top of that, I could see that a number of companies were really well positioned as top tier suppliers to the likes of Nvidia and the other top technology companies that were going to be spending vast amounts of money on building AI infrastructure. And I positioned Unstoppable and Neil's Top 40 in those semiconductor suppliers, effectively, that I felt would be really well positioned to benefit from that. So that was specifically harking back to what I've just said about bubble valuations and not having to sort of take that leap of faith. You have to, in order to play the game, you have to embrace ludicrous valuations. I don't think you have to do that. I think you can do it in the way that I've tried to do it in these two strategies, and it's working really quite well.
And I guess if you think about it, I mean, I spent some time thinking about it, over the past few months, trying to understand what's in your strategies and trying to understand how the mechanics of it all works. Because my brain works very logically. I like to understand, this happens, then this happens. And I suppose it does kind of make sense. If you've got companies like OpenAI trading on massive valuations, they're going to need to spend that money. The money they're receiving as investment, they're going to need to spend it in order to try and generate a return for their investors. And where are they going to spend it? Of course, they're going to spend it in the suppliers of components for data centers, data center manufacturers or builders, constructors themselves. Those kinds of things. So I guess they're going to lag behind slightly, but at least in my mind, that's quite a logical assessment.
Yeah, that's the sort of rationale that I started out with. Of course,
I'm just getting to it. Of course, 6 months after you did it. It takes me 6 months longer to process these things.
Well, yeah, this is not easy at any time. I think you've always got to constantly reevaluate your strategy. But my rationale at the start of this process was, I just don't know whether that's the right valuation for the likes of, the Mag 7 or the like. Well, of course, OpenAI is a private business, but these sorts of businesses, I just wasn't able to make a proper assessment. The valuations were in most cases, not just in the Mag 7, but around the Mag 7 and around the exciting AI plays. The valuations were very high, and I just didn't have the information or the confidence that these valuations were justifiable. That doesn't mean that they're not going to be good investments. It just means I can't rationalize them. But what I could rationalize and what I could understand is that a number of businesses that were going to be key components of this industrial revolution, that were going to be key suppliers to this industrial revolution, were on valuations that I could justify and rationalize, could understand, and they looked very, very exciting and very interesting. I didn't really understand why the market had completely overlooked them. But anyway, that's for another debate. But anyway, that's where I positioned the strategy. Now, the other aspect of this is that towards the end of last year, about a year ago, we were close to the lows in the Chinese market, and people like Goldman Sachs were saying that the Chinese market is uninvestable, and there was a generally very negative opinion about China as a destination for Western capital. Now, what's happened since is, well, I said at the time that looked a bit odd to me, and what I was able to do and what I set out to do when I was building these strategies is to look for really interesting opportunities in the sort of Chinese tech sector, some of which is very exposed to AI, of course, as well, where I could rationalize valuations. And I found a number of high-profile stocks that fulfilled that brief, and positioned both Unstoppable and Neil's Top 40 in a number of these high-profile, very highly regarded Chinese technology stocks, some of which were investing huge amounts in AI, but weren't trading on the sorts of valuations that their US equivalents were. That's why I positioned Unstoppable in a number of those companies, and that has proven to be the right thing to do as well, because they performed extremely well.
I wanted to ask about there's one sort of specific, maybe slightly technical question which I wanted to ask, which is, this month we've just started a new month. The W 4.0 members have just had their sort of update on the month of September from you.
Yep.
And you didn't make any changes to the strategies this month, even though, so just picking one of the biggest weighted stocks in Unstoppable Trends as an example, the share price of that stock is up 56% in the month, but you didn't adjust any of the weights. I just wanted to try to understand why that was. Just explain your approach to me.
Yeah, so what I've done is look at what's happened in recent months across the strategy, look at all the constituents of the strategy, and make a judgment about what would be the right weighting to have to that company in the strategy. Now, I've adjusted those on a number of occasions since we launched those strategies, and perhaps most notably in the US renewable energy stocks, which if anything have been the best performers over the period since the launch of the strategy. And that's partly because at the moment we launched them, these businesses were were at the bottom of a trough, effectively, of performance. And so I adjusted those down because they performed so well so quickly. The weights have become disproportionate across the strategy. More recently, because we've seen very good performance from across the board, we haven't had this disproportionate sort of movement in relative weights in the strategy, and that has that's been one important consideration to bear in mind. The other one, of course, is all the while I'm reevaluating the valuations that some of the top performers have moved on to, because of course in one or two instances the share prices have been so strong that the valuation basis has changed significantly.
I see. So it's almost like the news that's driving the share price, I guess, is also affecting your conviction level in that stock. Is that Is that the right way of explaining it?
Yeah, but I think it's important to convey a very sort of nuanced message. Okay, I've always talked about valuation. I drone on about it all the time, but it's not as if there is you can make a sort of decimal point judgment about what is the right valuation for a business. It typically is something that you feel about a range of outcomes, if you like, or a range of valuations. You couldn't, for example, I wouldn't have the confidence ever to say, well, 21 times earnings is the right number, but 22.5 is the wrong number. 40 times might be the wrong number, of course. 20 times might be somewhere near the right number. But do you see what I mean? The point is that it'll be wrong to portray this discipline as something that delivers a decimal point answer. You get a sense, if you like, of where a business is stretching the parameters of what would be an appropriate valuation. And in one or two cases, after extremely good performance, I'm beginning to sense that that may be the case in one or two of the positions. But I don't feel it strongly enough now to want to suddenly say, no, that's got to go, or that's got to be significantly reduced.
I see. That makes sense. And so just to kind of wrap up on these two, and coming back to the original question from Alex, these companies that you've selected to give exposure to the sort of technology or the AI theme, I guess, they're the picks and shovels layer. And the reason we say that is because it's an expression that goes back to the gold rush. I'm aware we say picks and shovels like people know what it means, but assuming that people know that you need a pick or a shovel to mine gold, and we're talking about the companies that sell the picks and shovels to the gold miners, that's the analogy.
It is.
But these are the enabling companies, and so that should, I guess, make them more resilient than a pure play AI stock if the valuations in the AI sector were to correct sharply. Is that correct? And is that a fair assessment?
Yes, I think it is a fair assessment. It doesn't mean that these share prices can't go down. Of course they can.
Of course.
But let me give you a good example. So today, there is an announcement that OpenAI, as part of the Stargate consortium, which is spending $500 billion over the next 3 years on AI infrastructure, has secured effectively an agreement, a contractual agreement, with SK Hynix and Samsung. These two Korean companies are the leading suppliers, along with Micron, but SK Hynix has the largest market share of the high bandwidth memory semiconductor industry. There are only three suppliers globally: Samsung, Hynix, and Micron, and Hynix is particularly well positioned in that market. And basically, OpenAI has agreed a contractual relationship with them to supply their memory devices effectively to Nvidia, who will make the chips that will go into the OpenAI data centers. So here's a classic example of what I tried to do to position the the two strategies in a way to benefit from this industrial revolution. I've focused on those businesses that would benefit from this huge level of investment, and it's now manifest, for example, in that contractual announcement, which we all saw today, which obviously has been taken very well in the case of SK Hynix in particular.
So Neil, on the other side, we've got the income-focused strategies, All-Rounder and Income Booster. Over the last 6 months, All-Rounder is up 12.8% and Income Booster is up 10.6%. Now, their drivers must have been very different. What's the sector allocation like on those two strategies?
In both strategies, there is no exposure, really directly or indirectly, to the AI industrial revolution. As the name implies, Income Booster is really all about high equity income from a range of companies, most of which are in the UK. There's a couple in Germany and one in the US.
I think it's sitting about 6.5% at the moment, the yield on that strategy, I think.
It's extraordinarily high, and as I said, and as I've said in the commentary on the strategy, the really important focus here is not just on high income from a range of different equities companies. It's very, very important to have dividend sustainability in those companies as well. So that's a key focus of the selections for that strategy. In All-Rounder, or the All-Rounder strategy, that is much more akin to a sort of a traditional income and growth type orientation. And it is predominantly focused on UK listed companies, of course. There are one or two international businesses in there, but again, it's a strategy focused on delivering a combination of capital growth and good income. It doesn't have exposure directly or indirectly at the moment to the AI industrial revolution in the way that Unstoppable Trends does and in the way that Neil's Top 40 does. But of course, it's absolutely the case that there are very few businesses globally, very few, I can't think of any, that really won't be impacted eventually by the AI industrial revolution. So by implication, the AI industrial revolution is going to sort of roll out over all of the businesses in All-Rounder and all in the businesses in Income Booster, but they'll be manifest in a different way.
Of course. So I think financial services is clearly a key sector for both of those strategies. And the financial services industry, is famously slow to adopt technology, but I think AI is an example where they should see, massive efficiencies by adopting over time.
I do buy into this concept. People far more intelligent and knowledgeable than me talk about how the adoption of AI is going to transform particularly service-based industries, whether it's the legal professional insurance industry or indeed financial services. So there is going to be a transformation. I think in there ought to be as well in terms of the delivery of public services as well. So AI is going to impact every single corner of the economy, and it already is to some extent. But the biggest impacts are clearly, to come over the next 3 to 5 years.
And if an AI bubble were to burst, as was the premise of Alex's question, the defensive positions in these strategies, would they be better placed to sort of weather that storm, or would they even benefit perhaps from a rotation into dividend paying or value oriented stocks? Is that something that could happen?
I suppose there are a number of points. Yes is the answer. Those two strategies would be much more insulated in an environment where bubble-like valuations in those companies that are leading the global AI industrial revolution were corrected. But my view is that investors should not really allow concerns about excessive valuation in one part of the market to overwhelm their long-term investment strategy, is really what I'm saying. So, for example, let me take you back to the tech bubble in 2000. And I'm not saying that this is how, this is going to sort of repeat itself. Absolutely not. But it's an instructive lesson. I underperformed dramatically when I was running funds in the lead up to the tech bubble bursting, and sort of started to sort of deflate really after the first quarter of 2000. I underperformed. My funds were underperforming at that time. When the bubble burst, obviously there was lots of the stocks that people owned because they'd bought into the sort of the bubble, which bubbles. I mean, lots of very sensible people over the years have written about bubbles only really being bubbles only reaching an excess when they've recruited the last investor. That bubble burst, and then what happened next is, of course, that the highly valued, overvalued bubble stocks crashed. Some never came back from that disaster that unfolded from March 2000 onwards. But other parts of the stock market, which had not been impacted by that bubble, indeed had been impacted to the extent that nobody really wanted to own those companies, and as a result their share prices were pretty weak, actually. Now those companies bounced back to a more normal valuation, and in the aftermath of that bubble bursting, those funds that I was running at the time went up quite significantly. So I think it's important to remember that bubble valuations often exist in a sort of corner of the market. Now, I'm not suggesting that if the AI industrial revolution bubble was to deflate rapidly, that wouldn't ripple across markets globally. I'm absolutely sure it would, but that could well be a very short-term phenomenon. And actually, as long as that correction didn't cause financial distress, and I frankly don't see why it should, other parts of the economy, other companies in other parts of the stock market could well do very well. So, I haven't got a crystal ball. I don't know exactly what's going to happen. I think it's too early to talk about a correction in the AI industrial revolution stock market phenomenon. But I do think there are early signs that it does have bubble-like characteristics.
So that's the balance that W 4.0 aims to give: visibility of the opportunities and the risks so that people can make their own judgments with full transparency. Neil, moving on to another big story this week, and that is the US government shutdown. It seems like the two parties just can't agree on a budget, and we've seen this happen before. But should investors be concerned, and is this bad news for the stock market?
The simple answer is no. I was looking at the history this morning. There have been 20 government shutdowns in the last 50 years. The longest duration was, I think, in Trump's first administration, which was 34 days. This latest government shutdown may last a reason. My guess is that it will drag on a bit. Having said that, the US stock market rises more often than it falls during government shutdowns, interestingly. I didn't know that until I checked the data this morning. I think the market is doing the right thing by just sort of shrugging, okay, at the moment. Everybody would prefer that the US government didn't go through these periodic sort of hissy fits, and that both sides of the aisle could agree on a budget. But at the moment, the politics in the US is quite polarized. Everybody's blaming each other for the failure to deliver a budget. But of course, as the shutdown continues and as it has a greater effect on employment and the labour market data, I think the message will come home that the political cost of allowing the shutdown to continue becomes too great for both sides, and they eventually arrive at an agreement. So that's how I see this sort of unfolding. At the moment, furloughed workers are sort of non-essential government non-essential employees. Essentially, parks are closed and that sort of thing. But nevertheless, if this continues for a while, it will show up in the US labor market data. Of course, to some extent, people will look through the effect that the government shutdown has had on labour market data, which is already, as we know, been quite weak. In fact, very weak most recently. At the margin, I think the political cost eventually becomes too great for both sides, and they come together for an agreement. So at the moment, both sides are relatively entrenched, blaming each other. Over the next few weeks, I imagine that they will come together and agree something. But this may go on a bit longer than previous shutdowns.
We've had another listener question. This one's from Colin, and it's about the UK. And this comes back to something that you wrote about last month, which is about the UK, stories about the UK heading for an IMF bailout. He wrote in and said that some commentators are adamant that it's, the UK will have to head to the IMF, and others have dismissed it as impossible because the UK issues its own currency. I really wanted to get your take on this, and so did Colin. What could this? First of all, is the UK heading for an IMF bailout?
No, it's total nonsense. It really is drivel. I just can't. I'm struggling to understand why everybody's jumping on this, frankly, ludicrous bandwagon. But that is the nature of consensus commentary on economics these days. I see no prospect of the UK needing an IMF bailout.
So, Neil, what is the difference between the bailout in 1976 and what's happening now?
The differences could not be more stark. The challenges in 1976 were the product of very, very different economic circumstances. The economy was overheating in the early 70s as a result of the barber boom. That was already creating inflationary pressure in the economy. Effectively, the old sort of anecdote of demand-driven inflation. And then what was overlaid on top of that, of course, was the Yom Kippur War and the Arab world basically embargoing the supply of oil. Oil prices trebled. That created even more inflationary pressure in the economy on the back of what was already building up as a result of the barber boom. And a consequence of all of that was that inflation went as high as, I think, about 25%. And interest rates went through the roof. Gilt yields went through the roof, and it was a mess. And ultimately, because we had a very unionized workforce, and the government sector was huge, and manufacturing was the biggest part of the economy then as well. I mean, all of these problems eventually resulted in the government going to the IMF for a bailout. Now, the circumstances today could not be more different. And I'm not going to waste everybody's time, but I would hope that you might, all the viewers, listeners, might be able to discern that today's macroeconomic environment in the UK is very, very, very different. Now that doesn't mean that all circumstances, you have to have the same set of circumstances to drive you to the IMF. I mean, Argentina has had multiple bailouts for all sorts of different reasons, but I just do not see where these people are coming from. There are clearly economic and public finance challenges confronting the UK government. It seems to me that the prognostications, these doom-laden prognostications, are predicated on a number of things. But first and foremost, they're predicated on a very poor economic performance in the underlying economy. They're predicated on no government action, no ability to cut spending, no ability to control spending. And in both cases, I think it's a very odd forecast, which I just don't subscribe to. If every single economy in the world would need an IMF bailout, if you forecast forward the sorts of things that the doom mongers are forecasting. Out of control public spending, terrible economic growth outcomes, increases in taxes that then in part slow the economy, disastrous productivity performance. All of it's very easy. I mean, every model of the economy, if you assume you can sort of you predetermine the sort of the answer to the question based on your inputs. And like any economic model, like any sort of computer program, if the assumptions are very bearish, the outcome is very bearish. And it just seems to me that all of these doom mongers that we're being assailed with at the moment, whether it's the economists or whether it's the ones that I've highlighted in recent weeks, all you need to do is just flex the assumptions, flex the inputs, and you get a completely different answer. So I don't dispute the fact that if you assume the world's going to hell in a handcart in the UK, if you assume that public spending can't be controlled, if you assume that the economy doesn't grow, if you assume productivity collapses going forward, yes, you're in a very difficult place in a few years' time. But none of those things are at all likely or probable, in my view, and a less extreme and a more rational set of expectations or forecasts or views about what will happen in the economy going forward produces a completely different answer. There is one more fundamental point here, which is that a foundational part of the bearish arguments about the outlook for the UK are focused on what's happened to public spending or what's happened to the national debt. It's gone up a lot. We now have about 40,000. I was trying to think how to simplify this argument. Let me give you some numbers. We now have about £40,000 worth of debt per head of population in the UK. It's a big number. It's £12,000 per head higher than it was before the pandemic. But let's think, well, why is it £12,000 per head higher? Well, it's higher because the government at the time, under a lot of pressure from the opposition, as a result of the political pressure and the advice that the government was getting at the time, the government embarked on a series of policies that cost a huge amount of money. We then had the war in Ukraine, and to a lesser extent, but not helpful, the government also embarked on a series of measures that were designed to insulate the economy from the worst effects of the increase in energy prices that followed the war in Ukraine. But those two events together had a very significant impact on the scale of public debt. And as a result, it's £12,000 per head higher than it was pre-pandemic. That doesn't mean that public spending is out of control. It just took a leg up as a result of those two extreme events. It seems to me that the bearish argument sort of takes that significant increase in public debt and says, well, it's going to carry on, ballooning out of control. I don't agree with that argument. But also, one has to look at, well, why did the public sector, why did the government decide to step in? Well, it stepped in because it locked down the economy. It basically said to the private sector, you can't do what you normally do, private sector. Everybody stays at home pretty much, apart from essential workers. Everybody stays at home until the pandemic has passed or we have a vaccine or whatever. But anyway, the fact is that the government had to step in and through the furlough scheme basically had to say, well, you can't not pay people if you've shut down their businesses. So you have to pay. So huge amounts of money were transferred from the government to the private sector. So if you just look at the public sector and think, well, the impact of those two things is horrendous, you're not getting the whole picture. Where did the money go? Where did this £12,000 per head go? Well, it went from the public sector in large part to the private sector. And that's why total bank deposits in the UK are £3 trillion. They're £700 billion higher than they were before the pandemic. That's 25% of the UK's GDP. The money was transferred effectively from the public sector, which borrowed the money, and it was transferred to the private sector, who pretty much saved the money. The reason that we have pressure on the public finances now is that we still are living with the legacy of the pandemic and the war. And as a result, savings ratio in the UK is nearly 11% of income. In the US, it's 4%. As a result of that, because demand in the economy is below where it would normally be had those events not happened, we have a huge increase in public saving, in household saving. We have a giant increase in bank deposits, which reflects that massive increase in saving. £700 billion more in bank deposits now than before the pandemic. We have total bank deposits, £3 trillion. In the UK, that is, well, the economy is about £2.6 trillion. So it's bigger than the entire size of the economy. 25% of GDP increase in bank deposits since the pandemic. You only have to think about, well, surely what happens going forward is that a bit of confidence returns to the economy and a bit of that excessive saving starts to be spent instead of saved. Now, what is the trigger that will lead to that change in consumer behavior? I think it's lower interest rates. I think lower interest rates will trigger more activity in the economy, that it will trigger lower saving from what is a very high level, nearly 11% of income. And as the economy saves less and spends more, so more tax receipts are generated. So pressure on the public finances diminishes because the economy is growing more quickly and because it's generating more tax revenue for the government. And the pressure is relieved in that sense. So the doomongers have to believe that we carry on saving a ridiculous amount of income, that productivity continues to be very poor, that the government isn't able to control public spending, that there is some sort of buyer strike in the gilt market. These are events that I would attach some probability to, but they are not, I believe, likely. Neither are they, in my view, plausible. They are extreme views that, when aggregated, when layered on top of each other, produce a very negative view about where the economy is headed and what might happen as a result of that very gloomy outlook.
So, to answer Colin's question, no, there's no chance in your mind that we're heading for an IMF bailout.
None.
Excellent. I think that's it for this week's episode of the podcast. Thank you again to Alex and Colin for their questions. As always, if you have a question you'd like me to put to Neil, send us a DM or comment on any of our social media channels, or drop an email to hello@w4pz.com. We'll put the best of those questions to Neil next week. Don't forget, you can subscribe to W4.0 to get full access to Neil's strategies and insights. But until next week's podcast episode, that'll be it from us. Until then, take care.